Welcome to the deep dive. Today we're taking a bit of a scalpel to corporate strategy. Our focus is surgically precise.
It really is.
We are analyzing the Q&A session from La-Z-Boy's recent fiscal 2026 second quarter earnings call.
Exactly. We're looking past, the headline financials and all the prepared scripts. The Q&A, that's really where the truth comes out.
It's where the analysts get to really push management.
And force them to reveal their forward-looking assumptions, the trade-offs they're making, and, the real roadmap for their century vision.
Okay.
So our mission here is to extract those core shifts.
Right. Especially on things like portfolio optimization and how they plan to boost efficiency in what seems to be a fundamentally choppy market.
That's the word they used.
Okay, let's unpack this immediately then. Starting with that, the immediate market temperature, executives kept using that word choppy to describe demand. What did the questions reveal about where this uncertainty is concentrated?
Well, an analyst, Anthony Lipidzinski, he really probed on that, on the geographic dispersion. And the executives, specifically CEO Melinda Whittington, said there was nothing dramatic in terms of choppiness across the U.S.
So it's pretty even.
Mostly.
Yeah.
But there was one clear exception they called out. Canada. Canada continues to be, and I'm quoting here, more challenged. And that challenge is directly tied to their specific trade and tariff situations up north.
So the big picture is consumer demand is just erratic.
Very. And that means the company has to be, highly agile and, frankly, prudent in how they forecast everything.
That prudence leads us right into pricing. This is where I think La-Z-Boy's competitive stance really starts to shine through.
It really does.
I mean, given the market volatility, rising costs, how aggressive were they with their price increases? What was the rationale?
Well, they're being incredibly deliberate. They confirmed taking some nominal pricing actions earlier in the fiscal year.
Right.
But then another round came in Q2, and that second one, that was entirely reactive. It was specifically triggered by changes in the U.S. 232 and sectoral tariffs on upholstered furniture.
And the tariffs being essentially the trade taxes the government imposes to protect domestic industries. So they just priced in that increased tax immediately.
Precisely. They had to cover those costs. But, and this is the critical insight, relative to their competitors, their pricing actions are remarkably light.
How light are we talking? Are we talking percentages or just comparative statements?
Oh, they gave percentages. They stated explicitly that their total pricing actions throughout the entire calendar year, 2025, are still in the single digits.
Wow, single digits.
And they really emphasize that this is at the very low end compared to what they're seeing and hearing from other major manufacturers and retailers.
Many of whom have passed on double-digit increases, right?
That's right. So their single-digit increase in price is a core competitive advantage. And, the proof is in the result.
Yeah.
Their main North America wholesale La-Z-Boy business saw flat volume year over year.
In this environment, flat is a huge win.
It absolutely is. It signals that their pricing strategy, that nominal increase, is being well accepted by the market. They're retaining loyalty and volume because they're below the market average.
It's disciplined.
It's disciplined pricing, not volume chasing.
So speaking of discipline and tariffs, another analyst, Robert Griffin, he asked about tariff coverage. Did the Q2 pricing only cover the immediate situation, or were they, looking ahead?
They were looking forward. The pricing actions they took in Q2 were explicitly designed to cover both the current tariffs and the expected change on January 1st.
So they're baking in future costs. That gives them some breathing room.
A lot of breathing room. And they feel uniquely positioned here because of their foundational strength, which is that roughly 90% of their finished goods are produced right here, domestically.
In the U.S.
In the U.S.
That domestic manufacturing is so key, isn't it? It shields them from so much of the supply chain chaos and, crucially, from a lot of the fluctuating international tariffs that are hammering their competitors. Yeah. And that clarity about what's core and what's not core, that leads us perfectly into what I think was the biggest story of the Q&A.
Oh, yeah.
The aggressive portfolio optimization.
This is where the strategy really pivots from offense, with pricing, to defense with efficiency. They are executing a classic financial trade-off. Big investments versus some really dramatic exits.
Okay, let's detail the investment side first. Where are they putting their capital?
They're investing heavily in their strategic retail footprint. Specifically, they just completed an acquisition of a 15-store network.
Okay.
And it's in the fast-growing Southeast U.S. They're targeting key markets like Atlanta, Orlando, Jacksonville. That move alone is expected to add an estimated $40 million in net sales to the company.
$40 million in high-growth, company-owned retail. Okay, now for the dramatic flip side. What are they actively shedding?
They're shedding $70 million worth of wholesale businesses.
70 million.
Yeah, and this is not a small cleanup. This is a radical excision of non-core product lines. This includes planned exits from Kincaid Case Goods, American Drew Case Goods, Kincaid Upholstery.
So a lot of the hard furniture.
A lot of it.
Yeah.
And even the closure of their entire UK manufacturing facility. All told, these exits represent a $70 million headwind in wholesale sales.
Wow. Okay, so hold on. Let's crunch those numbers for a second. 40 million acquired, 70 million shed.
Yep.
They are accepting a net decrease of $30 million in enterprise sales revenue. That is a huge bet. You don't take a $30 million revenue hit just for fun. What does this calculated loss buy them?
This is the crux of the entire call. This is it. That calculated loss buys them significant margin improvement.
Okay.
So while they're taking that $30 million net sales decrease, this entire shift, the acquisition, the exits, everything, is expected to yield a substantial adjusted operating margin improvement of 75 to 100 basis points.
For the entire enterprise.
For the entire enterprise.
And just to, put that in perspective for everyone listening, 100 basis points, that's a full 1% increase in their profit margin. 75 is 0.75%.
Exactly. They are sacrificing $30 million in top-line revenue, which they clearly deemed lower quality revenue, to buy up to 100 basis points of enterprise efficiency.
It's a signal.
It's a radical zero-tolerance approach to non-core drag. This isn't just optimization. It's a financial declaration that profitability trumps volume in these specific areas.
That is a powerful trade. They gain nearly a full point of margin by shedding businesses that just weren't core to their mission, especially those imported lines, which probably had lower margins and more risk anyway.
And critically, the timeline is aggressive. They expect all these actions to be substantially completed by the end of this fiscal year. They're pushing through the pain quickly to get to the benefit sooner.
So the strategic shift, it does raise a major operational question, which Robert Griffin also asked about.
Right.
Case goods. For listeners, case goods is the term for, non-upholstered, hard furniture, dressers, tables, that sort of thing. If they're exiting the wholesale case goods business, how does their in-store retail design business continue? It relies on selling whole rooms.
It's a very smart distinction to make. And the executives, they clarified it. They are exiting the wholesale side of case goods because, frankly, they acknowledged it's not their core competency. It's not where they have the right to win in manufacturing.
But they'll still sell it in their stores.
Absolutely. They will continue to offer optimized case goods offerings within their company-owned La-Z-Boy stores.
So they're shifting from being a manufacturer and a wholesale supplier of hard furniture to being a smart strategic sourcer.
Correct. The case goods are essential to enhance the upholstery experience. To service the consumer who wants a whole room solution or needs design sales. They want the sales flexibility without the manufacturing complexity and inventory risk that comes with that wholesale business.
That distinction makes perfect sense, especially in light of their focus on margin. Okay, so the portfolio is being cleaned up, it's being optimized. That addresses the internal drag. But what about the plan for external expansion? Organic growth. What are the key growth levers they talked about?
Well, retail expansion remains the primary lever. The long-term objective is aggressive. They're moving toward over 400 total stores.
Up from what, 370 now?
Up from 370 currently, yeah. And the pace of net new store growth is expected to continue in the 10 to 15 range annually. A very solid clip.
And importantly, this growth is heavily skewed toward company-owned stores, right? Not franchises.
Absolutely. The proportion of company-owned stores is now 60% of their network, which is a massive increase from just 5 years ago.
And that gives them more control.
Way more control over the customer experience, over inventory, and crucially, over margin capture. It all ties back to that efficiency focus.
And this store growth, it coincides perfectly with their successful brand identity rollout, which is getting a lot of buzz. I mean, they're working hard to prove they're more than your grandmother's recliner, right?
Yep.
Trying to pull in millennials and Gen X.
The rebranding, the design focus, the physical expansion, it's all running in parallel. They're making the stores look and feel more like design centers to align with that higher-end consumer who, is holding up pretty well in this K-shaped economy.
Okay, let's look at the wholesale expansion strategy, which Anthony Lebedzinski also probed. Are they looking to just add dozens of new retailers?
No, the strategy is really quality over quantity. They're focusing on compatible strategic partners, the ones with distribution that reaches consumers not currently served by their own galleries.
So who are the big wins?
They highlighted a few key ones. Living Spaces, which is a top 100 furniture retailer, Farmers Home Furniture, and the big one, Costco.
Landing Costco in 350 locations, that's huge distribution power.
It is. But going forward, executives said future wholesale growth is expected to come more from expansion with this existing partner base.
So deepening those relationships.
Exactly. Getting more floor space rather than just acquiring a lot of new, large customers. They want deep, profitable penetration.
Okay, now let's move to the other foundational shift that's going to define the next few years for them. The supply chain transformation. The CFO referenced friction costs multiple times in the guidance. This sounds like short-term pain. What are these pain points, and what's the big payoff?
This transformation is it's multi-year and it's vast.
Yeah.
They're undertaking a monumental shift, reducing their distribution footprint from 15 large distribution centers down to just 3.
15 down to 3. That's a complete overhaul of their logistics.
It is. The friction costs are those short-term, unavoidable inefficiencies you get during a transition like this.
Like what?
Things like dual lease costs, paying for the old facility while the new one is ramping up, and just various other transition cost-moving inventory, restructuring home delivery. The executives basically said it's unavoidable to be a little bit more inefficient in the short term.
But the long-term efficiency, that's the prize. What's the expected margin boost once this new centralized system is fully operational?
The payoff is substantial, and it builds on the gains from the portfolio cleanup. Once this is all done, this transformation is expected to deliver 50 to 75 basis points of wholesale segment margin improvement.
Which translates to what for the whole company?
That translates to up to 50 basis points on the total enterprise margin. And they're doing all this while simultaneously improving delivery speed, their radius, and their service levels.
So let me get this straight. We're looking at up to 100 basis points from the portfolio cleanup, plus up to 50 basis points from the supply chain.
That's right.
This company is strategically building a highly efficient platform, leveraging its domestic strength to just slash, drag, and boost profits.
I mean, if we connect this to the bigger picture, the strategy is about building 2 foundational layers of margin improvement. That's around 150 basis points of potential total.
Which gives them resilience.
Resilience, pricing power, and the cash flow required for that aggressive retail expansion we talked about.
That supply chain transformation is costly, which brings us perfectly to the question of cash. Let's wrap up with the near-term outlook for Q3 and how the company plans to use its capital. An analyst, Taylor Zick, asked about demand trends, noting that the comparable period post-election last year was very strong.
Right, and that strong comp makes Q3 a really difficult year-over-year comparison. Executives stated that consumer trends remain challenging and that early November was, in their words, mixed.
So they need to be careful.
They recognize they have to navigate this with laser precision. The main challenge is what they call the bifurcated consumer, or as we often call it, the K-shaped economy.
What are the two sides of that K-shape they're seeing?
Well, you've got the high-end consumer, the ones buying the whole room design packages, the leather, the power upgrades. Those sales are holding up well.
And the other side?
Then you have the value-conscious consumer who is highly sensitive to price and requires deep promotions just to drive traffic.
And how is that affecting promotional intensity across the industry?
Executives observed that the Labor Day tentpole event saw sharpened, deeper price points compared to Memorial Day.
So more aggressive sales.
It indicates a highly active marketplace where retailers are fighting hard for traffic. But here's the critical point. While the retail environment is fiercely promotional, La-Z-Boy's own cost of goods has only increased nominally.
Unlike competitors.
Exactly. So their relative competitive position on price remains strong. It lets them participate intelligently in promotions without just sacrificing market share.
Okay, final check on capital allocation. Given the high cost of that 15-store acquisition and the CapEx for the distribution overhaul, where's the cash going? Their long-term target is a 50-50 split between reinvesting and returning cash to shareholders.
For fiscal 2026, that allocation is intentionally tilted more into the business.
Because of those two big investments.
Precisely. They're in a heavy CapEx period. However, to demonstrate confidence in their long-term financial health, the board increased the regular quarterly dividend by a robust 10%.
And that's significant.
Very. It marks the 5th consecutive year of double-digit increases, which speaks volumes about their confidence in the eventual profitability of all these strategic moves.
It certainly sends a strong signal to shareholders. So what does this all mean for you, the listener? This Q&A, it really revealed a company proactively shedding $70 million in non-core sales to unlock significant margin potential up to 100 basis points, and using its financial strength to make strategic acquisitions in attractive high-growth markets.
The story here is fundamentally a shift. It's a move from, an old-school furniture conglomerate focused on revenue scale to a modern, margin-focused enterprise.
Yeah.
And they're paying upfront costs, both through lost revenue and those friction costs, to build this highly efficient, domestically supported platform.
So the immediate challenge is that navigation.
Exactly. It's navigating the short-term disruption of that massive supply chain overhaul against, a choppy consumer backdrop.
That's the tightrope walk. Indeed. And it raises an important question for you to mull over. Considering the aggressive rebranding efforts aimed at capturing millennials and Gen X and that strategic expansion into retail and massive wholesale partners like Costco, how soon will the margin benefit from the distribution network payoff translate into clear, measurable consumer loyalty, making the brand cool and indispensable again, beyond just its core recliner business? Thank you for diving deep with us today.